Holly, what are you telling your clients about whether we're in recession right now?
I'm telling my clients it doesn't matter if we're in a recession today. My clients, like your viewers, Sarah, don't care if we're technically in a recession or not in a recession. What they care about is how they weather this storm and if they can not impact their livelihood, continue to live their lives, and come out the other end of it. That's how we spend our time.
And a lot of your clients are high net worth.
Yeah.
Right? So what is the answer there? Are they feeling it?
So the answer is we always talk to our clients about managing risk. And from a high market, a low market, we position our portfolios to withstand a full business cycle. That includes upturns, which feel a lot better, and downturns like we're in now. So, of course, they can afford it. They're not going to like it when they open their statements, but they're positioned to do just fine during this downturn.
In previous appearances in the last few months, you've come on and you've said that you are positioning them more defensively, preparing for the downturn.
Correct.
Is that still the case? Has there been a change?
No, it is still the case. We still maintain a defensive positioning, so we're still underweight traditional asset classes like fixed income and equities. We're overweight alternatives because that's where we're seeing the opportunity for outsized returns. But what we're really cautioning the more scared investor and maybe the more scared viewer is not to have a knee-jerk reaction and the importance of staying invested, because as you know, the 10 days following the market bottom has proven to be very important to be invested with a 15% return on average.
So do you not buy the idea that, and a lot of people are talking about this today after the Powell news conference, that we have seen the biggest of the rate hikes and we're closer to the end than the beginning, and that could lead to a pretty nice market rally?
I'm not buying that, but it's impossible to know the market bottom. I think the first half of the year we spent talking about high inflation. I think the second half of the year, which has started, we're going to talk about slower growth. And the Fed is trying to thread the needle and navigate slowing growth enough to avoid a recession, but not too much to send the market tumbling.
But it's not the typical recession, right? Or are you using that playbook?
No, it's not the typical recession because, look, we have high employment. The housing market remains tight. I think we're relying on the consumer to continue to spend and work our way out of this downturn. But some people are saying we've seen the worst of it, and some people are saying the worst is yet to come. So the trick is navigating the uncertainty, and knowing that there is uncertainty tells us that there's going to be continued volatility.
I think in your basket there of recommendations, I know you're underweight stocks, but within the market, you like quality, you like dividends, and you like value still?
We do like value over growth, but the overriding theme really is high quality companies that have strong balance sheets, low leverage, strong pricing power, and companies that they themselves can withstand this volatility. So we're seeing, and you find high quality companies in every sector and subsector of the market. So what's really important there is, unlike previous rallies, is the market is finally giving some credibility to fundamental analysis, and that is justifying active managers. And active managers like Neuberger Berman managers are having their best start to a year since 2007.